Hello, this is Santosh Singh. I'm petroleum economist and I do financial and fiscal regime modeling for oil and gas upstream projects. In this video, I'll talk about the concept of cost recovery. Cost recovery is a widely used term in fiscal regimes which are based on profit sharing contracts. Basically, there are two kinds of fiscal regimes, and they are one of them is based on royalty tax, whereas the other is based on profit sharing contract or production sharing agreements. And cost recovery is a primary feature of any PSC or a PSA. Cost recovery is a mean by which a contractor can recoup his cost that he might have incurred in the process of generating oil and gas revenue. And this process is actually nothing unique to a PSC or a petroleum industry. Actually, cost recovery is a very generic concept. If you are an investor or a contractor or an oil company, and if you have invested in an oil project, the least that you can expect is to first get back your investment. I'm saying the least because that is the bare minimum that you would expect from your investment. If you get anything more than that, well and good, you have made a profit. But the minimum that you would like is to get back your cost first and anything else later. And cost recovery is a mechanism which helps you to recover your cost. Let me give you an example. Suppose you are a contractor, you have invested in an oil project, and suppose you are able to generate a revenue of $100. This is just to make it simple. So you have you have a revenue of $100, and suppose you have incurred a cost of $60 to generate this revenue. Now in a PSA, the government will allow you to take aside a part of the revenue against your cost. So you have a revenue of $100 and you made a cost of $60. So you can very easily say that, okay, I'm keeping aside $60 from the revenue for my cost recovery, and whatever is left after your cost recovery, that is 100 minus 60, that goes to the profit pool, and the government will tax you based on your share of the profit, not on the total revenue. So 100 is your revenue, 60 is your cost recovery because you have a cost of 60, and 40 becomes the profit pool. And in a PSC, that 40 will be shared between the contractor, that is you, and the government. And this sharing percentage depends from contract to contract. Sometimes it is 50-50, sometimes it could be 60-40 or 70-30, depends from contract to contract. Now you'll say that this cost recovery is looking very similar to the deduction in a royalty tax fiscal regime. What happens in a royalty tax is, if we take the same example, you have a revenue of $100 and you have a cost of 60. So for taxable income, you'll say that I have a deduction of 60, so my taxable income is 100 minus 60 equal to 40. So the government will take a tax only on that $40, which is your taxable income, and not on the 100. So in this context, your deduction and cost recovery are quite identical, and in fact they are identical because it is just a nomenclature which differentiates between a deduction in a royalty tax and a cost recovery mechanism in a profit sharing contract. That is a high level overview. But if you go into the nitty-gritty of cost recovery mechanism, you'll find that there is indeed a difference between cost recovery mechanism and a deduction of a royalty tax agreement, and that difference is in the sense that there is no limit for deductions. If you have a revenue of 100, you can use all that 100 against your deductions, but generally in a PSC there is always a limit on the available revenue for cost recovery purpose. In this example that I was talking earlier, so there is a limit of 50% on the gross revenue. So my gross revenue is 100 and I have a cost of 60, but I cannot use all my $100 against cost recovery, because now there is a limit on the gross revenue. So I can use only $50 to set aside for my cost, and in this case the cost is 60, but available revenue is only $50. So I can claim only $50 for cost recovery. I cannot claim $60. And so what happens to the remaining cost which I have not recovered? The remaining cost that I have not recovered is $10, because I have recovered only $50. My total cost is $60. So the difference of $10 becomes unrecovered cost. And in most cases, the government allows you to carry forward that unrecovered cost of your current period to the next accounting period, so that you will be recovering your unrecovered cost of past period from the available revenue of the future accounting periods. And this you can keep on doing until you are able to recover all your costs. So this limit or ceiling on the revenue for cost recovery is the differentiator between a cost recovery and a deduction of royalty tax agreement. Otherwise, if there is no ceiling, or if the ceiling is 100% of your revenue, then practically there is no difference between a cost recovery and a deduction mechanism of a royalty tax agreement. And there is one more differentiator actually between a cost recovery mechanism and a deduction scheme of royalty tax, and that is it impacts your entitlement. In a production sharing contract, the contractor is entitled, or he can book a reserve equal to your profit share and cost oil. Cost oil means the amount of revenue that you have recovered for your cost. So you are entitled for your cost oil and profit oil, and that is your reserve. Whereas in a royalty tax agreement, you can book all your revenue net of your royalty. So these terminologies impact your reserves and entitlement, and these are actually technical. I mean, mathematically you can arrive at the same entitlement, same government take and contractor take by designing suitably production sharing contract, which will give you same entitlement and same contractor take as of a royalty tax agreement. So more or less these are quite similar, but technically speaking they are different. So that is all about cost recovery, and I hope I have not confused you, and if I have confused you, then please do let me know so that I can be more clearer in my next videos. And thank you very much for watching this video. Bye bye.